move on to our next plenary of the summit, which is entitled Microfinance Sector Need to Re-Engineer the Model. May I request you all to please kindly have your seats. We are ready to start with this session. I'll request members of the audience who are still standing to please kindly be seated. It will enable us to start the session quickly. This session will explore whether the traditional microfinance model is still fit for purpose or whether it requires a fundamental re-engineering. Once again, requesting you all to please kindly have your seats. We are ready to start the session. Those of you who have just joined us, a gentle reminder to please do remember to either switch off your cell phones or put them on silent mode. And if you need to ask any question to any of the speakers, please do make sure that you scan the QR code. We have been sharing the QR code on screens. We're not asking you to put forth questions individually. May I request for the QR code to be shared on screen? There it is on your screens. Please do share this QR code. Scan it on your screens and you can share your questions through this QR code. Your questions will be directed to all the speakers. By scanning the QR code and sharing your question, we can include as many questions as possible without wasting much time. So please kindly do share this QR code with your friends or your colleagues who may not be here. Scan it on your screens. Share your questions. Participate and share your opinion or your question or query. Thank you. With that, I take the pleasure of inviting on stage Ms. Sonali Shapurwala, Managing Director and Head, Inclusive Banking Unit, HSBC India. Let's give her a warm welcome. Our esteemed moderator for this session, a very warm welcome to you. We take the pleasure of inviting our esteemed speakers. Please put your hands together for Mr. H.P. Singh, Managing Director, Satin Credit Care Network Limited. Mr. Sadaf Saeed, Chief Executive Officer, Muthoot Microfinance Limited. Mr. Sudipta Roy, Chief Executive Officer, L&T Finance Limited. Ms. Renigo Arul Selvan, Chief General Manager, National Bank for Agriculture and Rural Development, NABARD. Mr. G.G. Memin, a warm welcome to you. Executive Director and Chief Executive Officer, Sadhan. So there it is, ladies and gentlemen, the esteemed panel for microfinance sector need to re-engineer the model. That is the center and core thought for this session. So it's over to you, ma'am, to take the session forward.
Just check, is this working? Yeah, great. So no, thank you so much and thank you for this opportunity and I welcome the panel. I think it's a very topical subject that we are speaking about today, right? It's microfinance sector, does it need re-engineering? It's commonly said that the microfinance sector was innovated in Bangladesh, but if you have to see the success, you have to come to India. So that's really what the microfinance sector has done for India. I think, this success is actually celebrated globally. And I'm sure you all agree that this sector is a sector that we have to look up to. One of these few sectors that can actually claim, right, the reach, the resilience, and relevance that microfinance has delivered over the last 3 decades. However, we have to deal with the fact that sectors mature, right? And we may have to deal with some uncomfortable truths. Success does not deliver guarantee of future relevance. And I think that's very topical today. Today, the microfinance sector stands at crossroads. On one hand, we've seen it unprecedented scale, right? Regulatory maturity and capital which they've been able to attract from global, from domestic sources. However, on the other hand, we've also seen borrower distress. We've seen questions of responsible growth, climate vulnerability, and I dare to say a digitization wave that is faster than our collective readiness. Technology has improved, definitely, it has created efficiency. However, has it also distanced us from the borrower? Regulations have strengthened, for sure, and we see the regulator intervene constantly and designing regulations to create a conducive environment. However, but it sometimes struggles to keep pace with the innovation. So the real challenge in front of us is not survival, it is actually reinvention. Can we re-engineer the microfinance model to remain deeply human, however becoming digitally native? I think as regulators, as institutions, DFIs, civil society, I think we all align just not for compliance, but we have to get behind the outcome. I think the conversation today that we are hoping to have is whether microfinance is not what it has been. It is what microfinance must become if it has to remain credible, responsible, and transformative in the decades ahead. So as we move to our panelists, I hope the discussion today invokes some thought leadership on how we can reinvent and rebuild a model which is future ready for a Viksit Bharat. So before we begin, a quick word about the collective wisdom on this stage. When we added up the experience of all our panelists, it crossed well over 100 years. At that point, we decided to stop calculating, right? Some numbers are better respected than audited. So anyway, on a serious note, I think this panel, ladies and gentlemen, I think this panel that you see in front of you today, it has seen microfinance evolve. It has seen microfinance evolve from notebooks to dashboards, from intuition to algorithms, from regulatory by exception to regulation by design. They have navigated growth. They have navigated growth and stress cycles, busts and booms, policy resets, and have seen enough once-in-a-lifetime events that can last them a lifetime. So I think today's discussion is grounded in hard-earned experience, institutional memory, and lessons learned through successes and failures of this industry. In short, if experience were capital, this panel is extremely well capitalized. So with this, Mr. Silvan, if I can come to you with the first question. You know, some analysts joke that the number of times the word green shoot is used by bankers, lenders, generally, this number of actual green shoots in the entire botanical world is also not so much, right? The number of times we keep using green shoots. So while the recovery is real, it's actually being felt on the ground. However, the speed bumps that this microfinance space has seen are far more frequent today. NABARD sits at this very interesting play of, where it's intersection of policy, intent, capital deployment, and market discipline. From your vantage point, right? Is there something wrong with the business model? What structural weaknesses in the microfinance model worry you the most today? And which ones are we collectively underestimating? Maybe you can even tell us the risk mitigants to this. And just if I can add another question, if DFIs better incentivize the long-term impact, then shorter-term portfolio growth, is that something that we can look at DFIs to do?
Yeah, at the outset, thanks, Access, for inviting us to the panel, and we are part of this inclusive summit also. And as Madam has already put in focus the agenda for the discussion, let me just recollect what why we wanted inclusive growth first. Sabka Saath, Sabka Prayas and Sabka Vikas. That has been the mantra. And if India has to grow, we need to take the entire populace along. So in this regard, microfinance has been a driver towards this inclusive growth, capitalizing the undercapitalized people or serving the unserved. So we have been working towards that. See, some of the recent initiatives or recent challenges which we are facing is mainly what I would, from the Apex Bank perspective, if you see, it is the concentration of the sector. If you say it is concentrated in almost 83% of the portfolio is in the 10 states basically. And it is around 200, more than 200 districts cover the majority of the portfolio. So we have concentrated more into the areas, so that as a risk mitigant, we need to widen our concentration. This is one area which we need to focus. Second thing, see, earlier microfinance could have been a consumption-based lending. Now when you move to a production-based lending, when you lend, the monitoring mechanism, when we all meet the bankers in capacity building programs, we say when you are giving a loan, monitor the asset creation first. Is it happening? Are we monitoring the asset creation? Because once the asset is created, 50% chance of the loan going delinquent is taken care of. So, but are we able to build in the capacity and the skills among the people, and given the large attrition rate? So, but we have to understand that the workforce remains in the system. So if we build capacities, maybe he is not working for X or not working for Y, but he is going to build the sustainability of the ecosystem, financial ecosystem. So that need to be looked into. And we need to work, there is one more fundamental mantra of finance is never underfinance or never overfinance any asset. So have we looked into that? Okay, when you should not underfinance, but you should not leave excess money with your borrower, so that he gets into the consumption and he is not able to, he's getting into the indebtedness.
So you think that has been the problem?
That I think to some extent it is there. Maybe experts, industrial experts are there, because we are trying to, the assessment part has to be more realistic. The more realistic and more rigorous, I would say more rigorous, because the populace where we are serving, they are not that literate in financial management. Let us take it that way, because if we give too much money than they require, then they get into a cycle of indebtedness. So this area needs to be, the financial awareness is there, and a lot of stress has been on the digitization front. You also specified, and I think one of the speakers told in the previous session, have we lost the human connect? Because the fundamental mantra of microfinance, if you take the SHG bank linkage program or the joint liability group program, where collateral group is the collateral, it was the human connect which was facilitating the financial discipline. Have we lost the connect? So these things, I think we need to refocus on these areas to work towards a sustainable microfinance initiative. And to your question, is it required? Yes, it is required. It is required. It is required, and it is required because you have the reach. Okay, you have the reach. And another point which I would like to again specify here is the pricing of the loans also. Pricing of the loans also. We need to be wary that we need to balance the profitability angle with the social angle also. Otherwise, what we'll do is, because of a few errant cases here and there, the entire industry gets affected. And RBI is having a calculated scale-based regulation approach, and when they are giving you a freedom, then that comes with an accountability. So I think SROs have been insisting on discipline in these areas. So I think this will augur well for the sector to grow. I think this will be my initial remarks. Maybe I can come with few more points when you are.
Sure, we'll come back to you. I
during the
think
course
there are
of the
some
discussion.
very interesting takeaways from there. But Sudipta, if I can actually come to you now. L&T Finance brings deep balance sheet strength, right? Analytics, digital capabilities. I mean, you're building it out in the microfinance sector. But critics argue that as institutions get larger and more tech-driven, the micro in microfinance risks being diluted. How does your company, how does L&T Finance ensure that scale and digitization will enhance borrower outcomes rather than commoditizing them?
Thank you, Sonali, for that question, and thank Access for giving us an opportunity to be here. Of late, suddenly because of turnover events, etc., we have suddenly emerged as the second largest microfinance lender in the country after Bandhan, and obviously for us, scale is also, it's pretty large scale for us right now. It is our main business, and I think your question is very pertinent that, how much, and typically what happens is as you get larger, your discipline or your tightness that you have in large organizations tends to fray on the margin. So the big question is that as you grow larger, how do you maintain discipline in this particular business? Because I do believe that this business is all about discipline. In fact, having run many asset products across my banking career, I've come to realize that microfinance is a business that requires the maximum amount of discipline and the maximum amount of focus to run. Right? It is really a grueling business, and frankly, if you take your eye off the ball, you are in for trouble. The way we break it, and this is how L&T Finance approaches it. It might be different in other organizations, but the way we break it is that our digitization thrust is on a couple of axes. The most important part in the microfinance business, and over the last couple of years, I have realized that people probably did not pay too much attention to it, but it is the income estimation. See, if you estimate the income well, you will not go wrong in your lending decisions. If you are off in your income estimation, then you have a problem, right? So one of our income estimation algorithm actually has stood the test of time as well as has stood the test of the crisis last year, right? And when I joined L&T Finance, one of the things which I told my team is that I want this to be stress tested. Let me know whether this works or not. So we employed a Big Four consultant, and he said, look into the income estimation algorithm. Tell us whether this is right or this is wrong. One of the things which is very important is that rural incomes are not straight line. Rural incomes are sinusoidal, right? And that depends on whether a particular crop cycle is happening, whether some inclement environmental issues are happening, etc. So it's very important that algorithm generally encapsulates that and does those deductions to come to that level. The Big Five consultant came back and told us that it is, according to us, it is the gold standard because they do a lot of work. So we have improved on it. So that's the first axis, using technology to make sure that the income estimation algorithms are correct. The second thing, obviously, is to see what are the extraneous factors, right, in that particular geography, and whether there are events outside your control that is going to impact the credit quality. And that is also what we are currently building on as part of our what we call Nostradamus, which is our like early warning system, right, our portfolio management system, right, in which we have built macro algorithms, we have built micro algorithms, and with overlays, and this is on a GIS basis. So that is what we have built, and that will provide us advanced warning whether a particular geography should exhibit risk or not. The third thing is obviously workforce administration, right? So we have a methodology which we call Good Morning L&T, where at 5:50 a.m. in the morning, all our sales guys have to, and that's why I say it's a grueling business. At 5:50 a.m. in the morning, all our sales guys have to be at that at the meeting center point. Now, how do you monitor that digitally? So we have tools of measuring attendance and monitoring it digitally. Right? Also simple things like whether in a group meeting, previously we could see that group meeting people are coming, and I used to ask my question, what is your meeting center attendance percentage? We really could not answer that with 100% confidence because somebody could tick it off, right? Now what we have done is that we have done an AI-based solution where we take a picture of the group, and then the deep learning algorithm goes and matches of the faces with the application form and automatically marks attendance. Now that's very difficult to fudge, right? We have issues where the photograph is not clear, etc., and all that stuff. People try to game the system, right? But again, hammering makes sure that the system is not
Artificial
gamed.
intelligence hasn't yet reached the room.
So, last but not the least, and this is counterintuitive. A lot of people talk about digitization and digitization improving microfinance lending. The state which we see with maximum amount of digital payments is Telangana. Right? Telangana, almost 50 to 60% of our microfinance payments come by digital payments. But meeting center attendance is worst in Telangana. So it is divergent. Your digital payment maturity is divergent to meeting center attendance. So you will also have to see how you manage this. This is a new challenge that we are grappling with, right? Saying that how to make them come and still pay digitally. And we are working on incentives where they come, but still pay digitally. So obviously technology is important, discipline is important, income estimation is important. It's like a couple of things, right? And a couple of things that have to work together in unison, very, and obviously risk management and continuous risk management is also very important. So it's a business with many, many moving parts, and you have to run all the moving parts properly to make sure that you succeed in the business.
So not getting commoditized, right?
Not getting commoditized. Not getting commoditized.
Excellent. HP, if I can come to you, right? And I was reading one of your interviews, and it said that you broke your father's heart when you failed in chemistry and didn't get into medicine, right? And today you run a company that seems to have excellent chemistry with its borrowers. So I think my question is really around using technology, right? It's how you're bringing in more borrowers into the microfinance net. I mean, on a more futuristic note, right? Will this continue? Or will the dependence on technology be finally subjected to the law of diminishing returns? And I'm asking you this because we are seeing that the number of unique microfinance borrowers, the number is going down. So I just thought maybe, get your views on that.
Thanks, Sonali, and thank you, Access, for getting us here, You're right, I broke my father's heart, but finally, I think he wanted me to be a doctor. I finally got something, in terms of a doctorate, So
HP is a PhD and he's a doctorate, so he did get his doctorate.
But I think, I still have to become a doctor for microfinance, So I think that is something which is eluding all of us, But having said that, I think you are right. It's a mix of both. In fact, right now, if you really look at it, getting unique borrowers is like it's a pain point. If we looked at our data actually said that the new incoming borrowers, which are new to credit, have a far worse par than your existing clients or maybe a new to Saturn clients. So when you have this kind of a data, you technically will have to probably think about where to do it. So for us, I think what we've done in terms of the overall ecosystem, we've evolved ourselves into making microfinance believe in its depth. When we say depth, it actually means DEPTH.
Yeah.
And depth for us D stands for data driven. So we are an organization which is completely data driven. So we dissect, bisect, district wise, branch wise, borrower wise, center wise, loan officer wise. So that dissection happens across the entire landscape of our business model. E is employee centricity. Definitely there is a lot to be done in the employee space. I think the way we had a lot of institutions being there, the way I think it was all being focused towards being a 7 to 10 job. I think there was a lot of there was a lot of problem in this. So these employee benefit schemes, we brought in a lot, many of them. We are more focused towards our employee centricism, towards insurance, their healthcare, various other aspects to it, So E probably takes care of a larger part of attrition, because an old loan officer will technically be able to do much better than probably a new one who still has to, get his hands dirty into the ground, P is process driven, So for us, process is like sacrosanct, We follow from an acquisition of a customer to our servicing of a customer to a final, installments which we get, It's all process driven, There is no shortcut in the process. There is no which ways, this would lie in the hands of probably the branch manager or the loan officer, and it is all centralized, all based on various algorithms, predictive analysis, and everything. So process is completely, been there for us as sacrosanct. So T is for us technology. Now we are probably the first MFI to build their own LOS and LMS systems. And we've honed it across our years. We actually brought in 2017. After having done that, I think we've done so many improvisation. I think it gives us the speed to probably look at technology maybe in that kind of a frame, that we are able to customize whatever we want to do it. We are able to, create any kind of a data which probably had any kind of a report, any type of, analysis which has to be probably thrown in for our branch managers, loan officers, everything. So technology plays a vital part for us. Acquisition of a customer is probably just a very small fraction. Just to give you an example, for us, we started doing iris verification for acquisition of a customer much before people had even thought about it. People used to go with voter ID cards, maybe biometric to a certain extent. We said we'll do iris, because there is no actually chance of failing in that. So we brought in iris about 4 years back, and it's been working absolutely fine for us. We get a customer which is there based on technology, which is absolutely, I could say foolproof, H is household income, as what Sudipto said, You have to measure cash flows, you have to actually look at the household, You have to actually have a complete sense of what that household brings. It's not just the borrower, it's the complete package of the household which is there, So for us, depth is what we've tried to create in our system, and that is what we want to follow, for times to come. And that is probably, I think, where all this will head, diminishing, not diminishing, but I think it'll be far more better in terms of quality, moving forward,
So HP, just a quick follow-on, and if you can be honest, is the sector honest enough about where the growth has actually outpaced borrower capacity?
I think yes. I know it sounds controversial. A lot of people will not like this, but yes, I think, for us, it has to be a very, very cautious growth. I think, people used to talk about numbers, it was like, I used to hear it in, conferences, that, it's 17 lakh customers, it's like 17 lakh households, it's so much, I don't think so. I think, probably what is probably there is that, is there a requirement for this or not? Because we've got fintechs, we've got banks, we've got a lot of players who are there in the system, But do we actually need a system? Microfinance is all about touch, as what he said, you have to build that rapport with the borrower. It's not just, you just given paisa and it'll probably come, It's not like that. You have to build that. You have to understand their capacity to repay. You have to understand their desire to have maybe some more income. You have to understand whether there's a need for it or there's no need for it, If you go along that path, I think, then the environment is not that large enough, to probably talk about it. It's there, but you'll have to literally find out, as what he said, concentration in various districts, Well, it is there, we don't do some parts of UP. It's not because that we don't want to do it, but generally, I think the repayment culture, the way I think, things across over there is not conducive enough for microfinance to grow over there. We'll have to avoid that, come what may, whatever people might say, but, we will have to probably do that. So I think, you have to have a measured and a cautious growth, but yes, numbers are not something, which you had unbridled growth, people talking about 70% growth, 50% growth, 70% growth. I think that's passé now. It's not there anymore.
Thanks so much for your candidness, I think. And I think that takes me to Sadaf, and you've actually provided me a perfect segue, right? This entire business is all about touch and feel, right? So Muthoot's strength has historically been trust, physical presence, and relationship-based lending, right? Especially in rural India. But increasingly, we are seeing Muthoot has been now leveraging technology to reach to wider and deeper. In an era which is app-based, right? And I think you have a Mahila Mitra app which has got close to 2 million downloads. You've got eKYC. You're doing offline mobile capabilities to reach to people. So, a lot you're doing. I don't know, and somewhere I also read you're doing a super app, is it? Or I got the information wrong. So you're doing even a super app. So Muthoot is, really focused on going the technology way. How do you modernize, okay, without breaking the trust equation that microfinance depends on?
Thanks, Sonali, for that question. Thank you, Access, for putting us here. I think trust is fundamental and core to our business philosophy as Muthoot as a group is concerned. And as we see technology, I think technology we use to further enhance the trust. So the first purpose that we thought that we will build an app for our customer was to bring in transparency. And it is a transparency for the borrower also and for the employee also. Because I think in microfinance, traditionally it has been a business where most of the collection is in cash, and the borrower has to rely on the field officer, which is the relationship officer, where he is honestly depositing that money into the account. But as I think businesses are growing, there are deviant behavior from field officers once in a while. So the customer is not aware that whether our money has gone into our account or not in the loan account. So I think from that perspective, technology bridges the gap. So it gives a lot of transparency. Also, it is an empowering tool because in microfinance, traditionally the customer only comes to the branch maybe once during the time of taking the loan, but most of the servicing of the customer happens in the field. Where the center meeting, the collection happens, she does not have any kind of a direct contact to the branch, only that relationship officer can relay the message of the customer. But the app that is available to the customer allows her to kind of communicate with the organization, the lender directly, whether she wants more loan, whether she has any complaint, she wants to check a loan track record, she wants to download her loan track record. So that is the thought process that we went with. And of course, it brings in efficiency. It brings in efficiency from the loan officer point of view, that he doesn't have to go back and forth and give the statement to the customer. She is able to see the statement on that, and then digital payment. So all of this helps. I think the previous presentation we saw World Bank put out some data here, and it was very, very accurate as far as our experience is concerned. Initially, when we were building this app, there were apprehensions in the mind that our customer is not so literate, and our customer does not have a smartphone. So we addressed that challenge by thinking that if the customer does not have a smartphone at the household level, there would be one smartphone that would be available. We need to make sure that our app is downloaded at the household level of our customer. I think in that we succeeded. In our study, it was around 70% of the household have a smartphone. I think the study says around 80% of the phone, I think smartphone would be somewhere close to what we assess. So I think that really helped us. And I think as I look back, that was a decision, a very timely decision, because as we move forward, there are more and more data that is available for customer to access through the app, or for us also to study the customer. Sudipto talked about understanding the customer's income, and HP sir also talked about it. I think as we grow in microfinance industry, I think income assessment will become more and more important, and more data points are more and more relevant. I think no longer it is just a one-size-fits-all kind of a product. It has to be customized to the source of income and capacity of repayment of the borrower. And that can only be assessed if you have the accurate assessment of the customer's cash flow and income. So in that, the app helps really well. It is integrated with the aggregator platform. From the aggregator platform, we check the customer's footprint on the net, like what are the transactions through UPI they are doing, and also if they have any other bank account or any other saving or investment. So that helps quite a bit. So it brings transparency on the underwriting side also. We are able to assess the customer better and give the right amount of loan to the customer. And of course, it sorts the accessibility problem. We have gone to a stage now where we are looking at like a credit facility given to the customer upfront that, okay, you have a credit worthiness of ₹1 lakh or a 90,000 rupees. In one go, it will not be there, but as you repay, you can continue to draw down. So that thought process is there. But I think technology and trust go hand in hand. I think it is an enhancer in a sense that people's transparency, the availability of the data, and the efficiency improves with the technology. And I think going forward in microfinance, we would have to look at meaningful financial inclusion, and meaningful financial inclusion means digital inclusion also of the borrower. The way that you and I can today access our bank account sitting here, the customer should also be able to see her loan account, loan statement, borrow if she wants to through digitally. I think that is the way it is, and that is the path that we are taking.
Oh, thanks so much. I think, one more quick question, Sadaf, and if you can quickly sort of answer this, can relationship-led microfinance coexist with the cost pressures, right? And investor expectations. And we see this, all the time in our quarterly results, shareholder returns, that we all have pressures around. What is the one practice from traditional microfinance that digital-first players are getting wrong?
I think in our fundamental assessment of the business, touch and connect with the customer is super important. I think no matter how technologically advanced you are, how much technology you are using, but as long as you don't understand the customer well and you're not in touch with the customer, I don't think so you can be the preferred lender. Today, I'm not competing to be one of the lenders to the borrower. I'm trying to be the preferred lender. And I can only be a preferred lender to the customer if I'm in touch with her needs. And that I can only understand with my interaction. And that's what I think. It's natural, it's human kind of behavior. I want comfort, so I don't want weekly repayment. If once in a month, that's okay with me. If it's even lesser, then also it's better for me. But for a healthy interaction, we make sure that once in a month we are meeting with the customer. And ultimately, we also understand the ground reality. The customer is, if not illiterate, a semi-literate customer. So it's an assisted model. It's a digital journey, but at the forefront of it is the relationship officer who's helping her that, okay, this is how you have to do digital transaction for the first time, and then she learns how to do it. And if she has to avail other facility, maybe for the first time the officer has to tell her that, okay, here is how you apply the loan, here is how you can do some savings, you can buy gold ETF and all of those things. So it's an assisted journey, and I fundamentally believe that relationship as the core of this microfinance. And I think what differentiates us from maybe a fintech lender sitting in Hyderabad or sitting in Bangalore and lending and be at the forefront is our relationship with the borrower, and that will remain the core and the sanctity of it.
Got it. So Phygital very much here to stay, I guess. Gigi, if I can come to you, I think, from your lens of being one of the two SROs of this country, I know, what you saw in this sector, was it a deja vu? I think, what do you think caused this turmoil, right, in the sector? Over-expansion or overconfidence?
Thank you, Sonali, and thank you, Access, for bringing me for this session. I know maybe I was a last inclusion into this, but then with this I feel all the entire different players are on the stage. A banker, two major MFIs, one major NBFC who is a major participant or a player as far as microfinance is concerned, a DFI, maybe an SRO. Yeah, the question you asked me, I would say there are different reasons on that. See, if you see, microfinance sector had been going through different phases right from the beginning. It had experienced troubles on and off. Most of the troubles were because of something happened external. But this time it was different. This was more a self-inflicted one. It is more closer to what happened in Andhra Pradesh, I would say, in 2008, 9 and all, where the lenders went a little overboard and created a situation whereby probably an over-indebtedness have happened. That is one thing. There is a reason for that. If you see the microfinance sector in the last 5-6 years, even before the COVID, I'll say after the demon onwards, there had been something or other which was causing, the growth was getting stagnant. Maybe after the demon, then came an issue as far as the ILFS related issues were there. Then came COVID. So the growth was not happening the way it was expected, or it was being, the people wanted to have it. Then came COVID, and after the COVID, things looked everything fine. So suddenly there was an opportunity to grow faster, and that was a time probably the microfinance players took advantage of. At the same time, the RBI also relaxed these norms. So some of the norms like the lender norm or the loan amount norms, purpose, all these things got relaxed. So that was also another advantage which probably the players thought that unknowingly or knowingly, they took advantage on that. At the same time, if you see, unlike the earlier years, there had been a large number of players operating in the same space. Earlier, microfinance institutions were the only institutions used to be in this space. But now if you see, there are banks, there are SFBs, there are NBFCs, there are NBFC MFIs, non-NBFC MFIs, even some of the unregulated entities like Nidhi companies, or for that matter, fintechs, some of them regulated, some of them non-regulated. So there were large number of players around in the same space. So what has happened is that the supply of money became much more easier and large, I would say. And because of that, even the discipline the borrower needs to observe, that also got diluted. If you don't give me, I have some other option. So unlike earlier times, I had to depend on a particular X or Y MFI, and they used to give me as per the norms which are prescribed by them. The meetings has to be there, the attendance has to be there, the money has to be brought to the group. All those norms was to be followed. But today, I am not that bothered. I can go to another place and get the money. So all these factors came together and resulted in a situation by which larger and the borrowing became much beyond, some of them much beyond their capability or much beyond their means, and that caused us stress. And one more thing is that there is also a problem of data asymmetry. If you see most of the MFIs depend on the credit bureau data for the purpose of their underwriting, loan underwriting. So when you see here, when HCP subs talked about the income assessment. Income assessment is one of the major requirements, that's no doubt about it. At the same time, the liability assessment is also equally important or more important, I would say. So to understand the liability assessment, for the liability assessment, you should know from where the borrowers are borrowed. I said there are so many opportunities, there are so many avenues for borrowing, and all this, if information is not available to the lender, that again a problem. In credit bureau, if you see, only the regulated entity data is getting captured. Not even SHG bank linkage data is getting captured individually. And we know that most of the MFI borrowers, 60-70% of the borrowers must be also SHG borrowers. So how much they borrowed through SHGs, that is not available. How much they borrowed from a non-regulated entity, not available. How much they borrowed from a cooperative society, not available. So a lot of issues came together. I think that has caused the stress, that has caused an over-indebtedness, that has caused a stress. So the only solution to this is that, as it has been already told by that, we need to spend a little more time with the groups. we need to spend a little more time with the borrowers, try to understand them, tries to get the information about how much their liability is from various sources, how much their income is from the various sources, and come to a situation, come to an assessment whereby you can take a decision whether to lend, how much to lend, what to lend at all.
Thanks so much, Gigi. Conscious of time, but I think, having such a panel here with such deep insights and experience, I think it's worth very quickly sort of, getting in and trying to get in a couple of more questions. Let's do some blue sky thinking, okay? Let's change track now and see what we can do. I'm conscious that India's GDP today is about at the $4 trillion mark, right? And microfinance is a highly important area for us. It's for many stakeholders. There are different regulations for microfinance, and there's a whole set of lenders which actually feeds into this ecosystem. So there's a very nice ecosystem around microfinance to make it. But now let's do a bit of fast forward. India at the 10 trillion mark, right? How do we see then microfinance evolve? Can this industry survive when India hits the 10 trillion mark? Would this industry still be critical for stakeholders then? And please don't misunderstand me. It's not that I'm saying let's do away with microfinance regulation because, when we are 10 trillion, we may not need this. Not at all. That's not what I'm saying. What I'm suggesting, would our economy then be offering different solutions as to how we are reaching the underserved, right? And maybe just a quick, if you can sort of, today, if you had to start the microfinance industry based on your learnings, based on your tech, based on the data, how would you now perceive the future of microfinance? So maybe I can start with you and then go around very quickly.
No, I know there are no easy answers to this. First and foremost thing is that you have to understand that the industry has to go sustainably. That's the most important thing. 3 steps forward, 2 steps forward, 2 steps backwards is not the solution to it. The crisis that we had last year actually has put back the industry because, at peak we are at 4.3 lakh crores, 4.4 lakh crores, now we are about 3.3 lakh crores. 11 million borrowers have gone out of the system. At peak, we are about 7 million borrowers, 11 million borrowers are outside. 70 million borrowers, 11 million borrowers are out of the system. So I think the first step is that to have a very disciplined industry. See, discipline compounds. You do not require cutting edge technology, you do not require, but you need the industry to be disciplined. And if the industry is disciplined, and obviously now we have a lot of guardrails that has come out, and the industry is showing the maturity and the inclination to cut their coat according to the cloth, according to those guardrails. So first thing is the disciplined execution. That is what is needed. If we do disciplined execution without following into a credit ditch, right, then this industry will compound at a particular growth rate. The next question is that what is that growth rate, right? Is it a 30% growth rate? Is it a 40% growth rate? Now, this is my viewpoint. Do not hold me to it. I have other panelists in the group. But I think the safe speed for this industry is somewhere between 15 to 20%, not the 30 to 40% growth rates that we saw in the post-COVID period. The safe speed is between that. Now, some organizations might grow at 25%, some organizations might go at 15%, but I do believe 15 to 20% growth rate is a sweet spot. The third thing is that, distribution expansion. There are certain markets which are generally taken to be credit averse. Granular distribution expansion. And frankly, the credit guarantee which the industry had been asking from the government, if that comes through, that will be a big enabler. Because many of the players are actually starved of liquidity, right? So if that liquidity tap, right, which can be given, is available on tap, then obviously it will push forward the growth. Technology is an enabler now. The DPIs in India are the best in the world, right? So technology will help this industry grow. It is about discipline, it is about liquidity, and last but not the least, it is about making sure that you do not rev the engine too fast, right? They are the 3 things, and we can triple this industry in the next 10 years. That's my belief.
Excellent. So the bell keeps ringing and telling me that we have to, but maybe Mr. Selvan
Yeah,
very quickly,
actually
if you
here
can
one
tell
point
me. And
I would like to specify is we need to shift from volume to quality of the loans.
Yeah.
See, there are different set of livelihood finance is there, livelihood finance is there, enterprise loans. These have to be focused on if this industry needs to be relevant. And one more thing, we need to pass on the benefit of, say, the investments
Mike.
in the investments which you make on digitization, that is going to bring in efficiency and that is going to bring down your cost of operation. That has to be passed on to the ultimate beneficiaries. And of course, like sir was pointing out, the guarded risk management practices and having some counter-cyclical buffers as an industry as a whole, we need to have it if we are to sustain the growth momentum and our relevance in the sector.
Sadaf, HP very quickly, still relevant at the 10 trillion mark?
You wanna? Yeah, so definitely, I think industry has the potential.
Yeah.
There is enough
Yeah,
and more to kind of do with the borrowers. I think one thing that we have to look is where the customer is moving. Because the customer, I can give you an example. We have given in our presentation as well at our last board meeting. There is a customer who was with us in 2017. We gave her a 25,000 rupee loan. She was earning 6,000 rupee per month. But she has now progressed and she has moved to earning 60,000 rupee per month. And she is now employing 1 or 2 employees also into that business. I think that is where the journey is going to take us. Like our customers are going to progress further. Sudipto talked about 11 million customers who have gone out of microfinance. Some of them, of course, have gone out because of the default and some of them have progressed upwards and they've gone into a new segment. So I think that also needs to be taken care of. And I think by the time the GDP touches 10 trillion, I think microfinance will also progress in a much more meaningful way. And I think every shake-up we have learned something. During demonetization, we all started disbursing loan digitally completely. COVID happened, a lot of innovation on technology happened in terms of apps came in, digital collection came in. I think this crisis has also taught us to assess the income more in depth. I think that is what is required. And I think going back to the basic is that discipline is the most important thing that we need to, whether it's in growth, whether it's underwriting, whether it's in selection. And for sustainability of the sector, I think the most important is cash flow and the free flow of fund from banks have to continue for sector to continue to grow. And I think it's a very important and relevant sector which needs support.
Sounds good. I think, microfinance very much here to stay, whatever the size of economy. Very quickly, I'm going to take 1 minute, but it's good to get a sense around the room. And if the audience can just put up their hands on this question, it will just help. Very quickly, idea is just to get a sense around this room, right? I've actually got a few, and then I will take, because I think many of the questions are still looking back. I think let's look a little forward and see what we can, but I will take a few there. How many of you believe, and if you can keep your hands up for a second, right? How many of you believe that microfinance in India now needs a fundamental redesign and not incremental fixes? With a show of hands, please. Oh, I thought that, my God, so that's very few hands. Seems like the model is working well. Right. How many believe that digitization has improved efficiency, but has also increased borrower risk? Oh, wow. Again, very few in the room. Yeah. And how many believe that it has clearly reduced risk? Okay. So a lot of them feel it. Okay. Excellent. How many of you believe borrower resilience should take priority over growth, even if it means slower expansion and lower short-term returns? Oh, okay. I think that's just giving me the politically correct answer, right? So I think everybody sort of put hands, but thank you. I think, the hands, the show of hands, the discussions that we've had in this room make one thing very clear. The intent to change exists. Now the responsibility is to act. I think microfinance was designed to actually create entrepreneurs and not eternal borrowers. I think that really sums up.
I'll
Yes,
sum up
please.
with one last point. Actually, RBI's orientation has been on consumer protection. Although they have given a deregulated framework for the MFIs, but their focus is on consumer protection also. So in these areas, all the industry players need to work on, be it grievance management, the loan documentation, the openness in which the interest rates and the charges are being conveyed, and it is made understandable to the beneficiary in a better manner. So these things, no, then I think all of us have been talking about discipline. Discipline, this consumer protection angle, if you put in place, then discipline will be taken care to a larger extent, because here, on the one hand, the management will be pushing the employees to achieve the target, but on the other hand, it has to take care of all these areas. So this is one area which I think we need to focus on also.
So,
Sorry,
please.
one
Gigi.
point from my side. See, financial education, that is something very, very important. See, giving loan, especially for a vulnerable session like the one we are catering to, for them, if money is available, they would be easily tempted to borrow, because their requirements are there, their aspirations are there. So they would be tempted to borrow. So if, as I said, now suppliers are also more, if money is also available easily, so there would be a temptation to borrow. So making them understand how to make use of the money, how to borrow judiciously, prudently, so that is also an important thing. Responsible lending
Gigi,
is
actually, if
one
I
thing.
can intervene there, there's a question which says, if a borrower's income is seasonal, why is our EMI always permanent?
If a borrower's income is seasonal, why is...
Yeah, so I think you were actually addressing that right now. So-
Basically, what I'm trying to say is that responsible lending is one aspect, which even Sullivan also told about the customer protection and all. But responsible borrowing is also an important aspect, for which probably you need to spend more time and energy and resources to educate the people, because they are the vulnerable ones.
Yes.
One point here. Actually, many of us are sitting here. How many of us borrow for a holiday? How many of us borrow for going on a holiday? No, now, but the generation which is there, it is saying that they are borrowing for going on a holiday. See, normally we borrow for capital asset building to build our, our savings will be used for our leisure. So we need to take note of that angle also. That is. Sorry to interrupt.
No worries. So, I think, if you look at the crux, inclusion has to be inclusion, not just microcredit. I think, that's the crux. I think, we all have to understand, we have to do savings, we have to do insurance, we have to do, what you said, maybe EMI for premium financing for insurance policies and everything. So inclusion is not limited to a monoline, product which we have, unless and until that maturity happens, unless until that is given. I think we can still talk in circles about microfinance being big, small, whatever it is. I think at the end, the ultimate answer is that do you have so many products which you can probably do and do it? Deposit liabilities, basically why are we not getting deposits? We can do it because our borrowers definitely, because I can just give, I'll take a minute, basically. When we started our whole journey of Satin, we used to, finance shopkeepers, You won't believe it, we had 4,000 shopkeepers. Out of that 4,000, 3,500 were giving us deposits also. It was like pigment deposits every day. We had a category A license at that point of time, So, in fact, that is the double whammy which is there. Today my borrowers do not have the, they have the capability, but they don't have the avenues to probably do that, So I think, inclusion has to be larger than what it is right now.
And I think there was a question around microfinance borrowers' indebtedness. I think the panel did touch upon it. As long as the money is available, they are getting indebted. But the whole idea is, I think, and the panel spoke about it, is how do we assess income better? How do we ensure, I think, education is there for them to decide that their cash flows are enough to pay, and not just because money is freely available, I think. But the sector is here to say, sorry. And as I conclude, I know I've been keeping you away from your lunch, but I hope this panel has given you enough food for thought, right? So enjoy your lunch, and I thank the panel for a really invigorating discussion, and thank you very much.
All of our speakers, we deeply appreciate you taking your time to join us here and sharing your experiences and insights. And a special word of thanks to the esteemed moderator, Ms. Sonali Shapurwala. We have small mementos for all of our speakers as a token of our appreciation for their time and input. I'll request the team to hand them as they leave the stage.